Roger Montgomery, and welcome to this week's Video Insight. If on January the 1st this year, I told you that China would launch a cheaper AI large language model, Trump would impose additional tariffs on China and announce new 25% tariffs on Canada, Mexico and Europe, that inflation would rise and that geopolitics would become even less stable than it already is, what would you say the S&P should do in the first 2 months of the year? If you had said it should go up at all, you'd probably be in the minority. But at the time we recorded this video, you were right. The S&P 500 had risen by just over 1.2% for the first 2 months of calendar 2025. It's especially curious given the most recent American Association of Individual Investors survey revealed the 6th highest spike in bearish expectations since records began in the 1980s. Interestingly, amid all the negative news being released, there have been some sizable adverse market moves during the day, but by the end of the day, they often have been erased. So what gives? Well, it probably all comes back to liquidity, something we've written about extensively on the blog. And the good news has been that global liquidity has, according to cross-border capital, been inching higher after declining during the latter part of 2024. The lag between changes in liquidity and investor behaviour explains the 21% drop in Bitcoin recently, as it does the recent 4.6% decline in the S&P 500 from its highs. Meanwhile, evidence of a slowing US economy may also explain the 50 basis point drop recently in US Treasury yields. Of course, newly appointed Treasury Secretary Scott Bessent will be cheering the lower funding costs associated with the refinancing of some $3 trillion of Treasury debt this year, but one expects that President Trump will want to engage in psyops to blame someone else for the faltering economy. That the US economy is faltering can be explained by the reduction in the pace of liquidity growth from last year. Slowing liquidity growth impacts real economies, and the massive stimulus of last year has faded as many of the tools used, such as the US reverse repurchase agreement account, have now been exhausted. As we've indicated in other blog posts, a huge amount of debt refinancing is on the horizon, and this will drain liquidity from markets, meaning unless central banks engage in quantitative easing to keep the punch flowing, markets could have or experience a bit more volatility. For now, markets continue to climb a wall of worry, and provided the macroeconomic backdrop includes disinflation and positive economic growth, that positive bias should continue. But if liquidity is put into question, or inflation, or economic growth, and remember all three of those are needed for the market to generate a third year of impressive returns, then the market could succumb to price weakness. Unfortunately, even that backdrop of those three positive influences might not insulate markets from the volatility being created by Trump and his gleeful band of enablers. This year, as we said right at the start, is likely to be more volatile, and the returns are unlikely to be as high as the last 2 years. But whether they're positive or negative really comes down to the expectations of those three things: inflation, growth, and liquidity. If any of those three stumble, so will markets. That's all we've got time for this week. Be sure to continue to follow us on Facebook and Twitter, and I'll see you again soon.